This is More Knowledge, More Wealth with your host, Gabriel Shahin. Gabriel is a certified financial planner and a registered investment advisor at Falcon Wealth Planning. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the services or securities discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full informed investment decision. Now here's your host, Gabriel Shahin.
Good day. This is Gabriel Shahin, certified financial planner, and your host of More Knowledge, More Wealth, here on every weekend talking about all important topics of personal finance. My goal is to give you the knowledge you need to increase your wealth. Now, to the listener, you can always reach out to myself or any one of our colleagues here at Falcon Wealth Planning. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird, or visit our website at falconwealthplanning.com. That's FalconWP.com for short. Now, I'm the principal of Falcon Wealth Planning. We are a fee-only, non-commissioned, true fiduciary, folks, and we help anything that involves a dollar sign, folks. That doesn't matter what's going on in your financial situation. That's where you are today, how retirement looks like. Talk about taxes, investments, estate planning, insurance, folks, you name it. Anything that involves a dollar sign, we would love to help. And we're offering a free financial assessment where we're giving you 1 to 2 meetings of our time, 1 to 2 hours of our time, folks, at no cost, folks. Give us a call. We got offices all across, scattered through multiple states. And we are here in Southern California with our headquarters. We would love to help you. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird. And feel free, if you have a question, you want us to play it on the show, send an email to radio@falconwp.com. That's radio@falconwp.com. Folks, lots to go over with you today. I like to go over just kind of a post that I recently had on Twitter talking about the debt ceiling. Now, people are freaking out about it, and I'll let you know what are realistic situations that could happen from the debt ceiling. But at the end of the day, I don't want to say this as cavalier or maybe as insensitive as possible, but who cares? This has happened so many times throughout U.S. history. I mean, this is the 78th time it has happened and where they've increased the debt ceiling. It's a very normal situation. And quite frankly, when you start looking at some of the data, as I have pulled up over here, when you start taking a look at it, when you look at what happened after a debt ceiling, and normally historically, 3 months prior to the debt ceiling, the U.S. stock market drops about 5%. Okay? When you look historically, 1 year later, the market goes up almost 10%. Okay, that's what happened in 2011. We look at 2013, the debt standoff. 3 months prior, the market was up 3%. 1 year later, it was up 20%. And this has just consistently been the case. And when you take a look at just in general, what's going on in the markets, and when you look since 1976, how many times we've had debt ceiling? We've had it in 1976, 1977, we had it September 30th, October 31st, November 30th, we had 3 times. Just in 1977, we had again in 1978, again in 1979. We had in 81, 82, again in 82, 3 months later, 83, 84, again in 84, just a few days later. And then you have 86, 87, 1990, 1995 happened twice, 2013, 2018 happened 3 times, with the longest recorded for 35 days it lasted. Okay. Now, what does that mean for 35 days? Does that mean that it's taking where U.S. can't print checks? Does that mean that people are missing Social Security payments? That's not the case. Now, there are certain things where, yes, the federal government does in fact shut down, but does that mean the U.S. truly stops? And that's just not the case. Yes, you have some people furloughed. You have some people unemployed. There's talks that the unemployment rate will go from 3% to 5%. I hope it does. They can finally say we're in a recession at that point. But the point is simple. To think that this is the end of everything, this has happened so many times. So to freak out on something like this is not that big of a deal. Now, I will tell you one thing that does and may get affected, depending on how long this were to go on. And keep in mind, during the Trump administration, it went on for quite some time. It was the longest history, over a month. Now, what could happen now? Now, during the June 1st, they're looking for the shutdown, which is quite frankly right around the corner. Hello, happy Memorial Day. But the idea is what will that do? Now, the payments, for example, on U.S. Treasuries does stop. Okay, that's why they say, will U.S. default? Now, if you have money in U.S. Treasuries that are coming due, or you want to liquidate, that could cause some issues. In addition to that, money markets right now are fantastic rates. You can get money market rates for 4.5% rates, money market. Some of these FDIC insured. But with that being said, how are they being able to get you that 4.5%? The way they're able to get that is by truly investing your money in other things, because you're too scared to do it. They'll invest it on your behalf. This is some of the issues that happen to Silicon Valley Bank, might I add. By the way, folks, if you're just joining me, you're listening to Gabriel Shahin, certified financial planner, and your host of More Knowledge, More Wealth here on every weekend, talking about all important topics of personal finance. I'm going to talk to you right now about the consequences of a potential debt, having the debt ceiling raised, and more importantly, the government shutdown. Where I'm going with this is financial institutions right now, they're able to pay 4 to 4.5% on your savings account right now is they're taking your money and they're investing in U.S. Treasuries that are paying over 5%. Now, here's the thing. The $1 that you deposit with them, they can lend up to $10. In this case, they can take 10 times your money. So let's do the math here, okay? Because I know what you're thinking. If you have $1 million and they're paying you, the banks, 4%, okay? They're paying you $40,000 a year. That's pretty good. Now, if they're now getting U.S. Treasury at 5%, that's $50,000 a year on your million. So they're netting the banks $10,000. But here's the thing. The banks can leverage your money. They're not making just the $10,000. The banks can leverage your money, depending on the time. We'll look at a time like now, 10 times. So your $1 million deposit can be leveraged, right? How much? 10 times to $10 million. At a 5% U.S. Treasury, they can make $500,000 annually based on your $1 million deposit. Holy smokes, folks. That is why you're seeing significant pushes for savings accounts and higher rates, and why banks are competing. Some banks are doing 3.5, others raised it to 4, others 4.25, others 4.5, because they are understanding the concept of needing your money to make more money. Not many people are lending anymore, but they are smart. They can finally earn more than 0. nothing, and they are taking your money and reinvesting it. This is the issue that could happen with a government shutdown, is those payments will not be made because the U.S. Treasury will not be fulfilled. The default will take an effect. Now, default doesn't mean that's it. It's over. It's not like a car that gets repossessed. It's over. No more car because you missed your payment. No. What that means is it will continue to accumulate and they will pay you out once this agreement is settled, once they raise the debt ceiling. The government's saying they have an allowance. They need a higher allowance. They need to print more money. And so you have to know the impact. Your savings account, your money market account may be impacted where you may not able to get your money out. And if you do try to get your money out, these money market accounts, money markets specifically, they say they break $1. Well, what do you mean? Well, if you have $1 million in there, it's trading at $1 a share. Well, they might give you $99, $98 a share or 98 cents a share, which means you won't have $1 million. You'll have $990,000. You'll have $980,000. This is what happened in 2008. So be careful of your money. Understand, when do you need your money? How much access do you need? Because it is possible you may not be able to get access to it. Folks, if you have any questions with this, if what I'm talking like sounds like it may relate to you, if you need some help of where you can put your money, where it can be saved, where it can be secured, understanding your financial institution and where you having your money, making sure they are big, they're strong, they're liquid, and what you're putting your money in is actually truly liquid, give us a call. We would love to help. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird. Or visit our website at falconwealthplanning.com. That's falconwp.com for sure. Now, I wasn't able to do a show for the past couple of weeks, so thank you for bearing with me here. I actually had laryngitis. Imagine, I wasn't able to talk for 5 days. Then the infection spread to my ears. I went borderline deaf in one ear, still even waiting for some of the hearing to come back. It's kind of crazy when you start looking at your specific situation, your specific livelihood, your day-to-day operation and how, just like that, it can be affected. And not just from a disability, an accident, a situation that can disable you, but something, as we've all far too known, as something as simple as COVID. How we've seen people that truly die. Now, it's unfortunate that the government made these crazy benefits to hospitals where it's everybody who died, they just said it was through COVID related reasons. But there are true people that actually got seriously affected, and some truly that passed away from COVID. Now, COVID is gone. It's over with. Now, flu is back, influenza is back, and now people are passing away from that. I like, oh, by the way, they always have. Could range from 30,000 deaths up to $100,000 deaths on an annual basis, legitimately, of the flu. The reason I bring this up to you is taking a look at your situation. And maybe your situation, you were saying, hey, when I pass, who cares? But there may be some people dependent on you. This is where you have to start to look at what benefits are available. What is the financial situation like of the people that you care to take care of when you're no longer here? This can be kids, family members, spouses, ever. Understanding your situation is important. And so we are offering a free financial assessment truly to help relate this show to your specific situation, to answer those questions. And it was a really big kind of situation myself. Now, for myself to really reflect on. Now, luckily for me, I own the company, right? We have a large firm. We have staff over 50 people. We have over a dozen advisors. We serve multiple states. So it's a blessing on my end, but it really had me focusing on our clients and making sure that they're protected. Number one, for disability reasons. Number two, death reasons. And number three, just end of life reasons. I've had more and more situations where sadly people have needed maybe skilled nursing. People have needed specific care. And it starts something as simple as Meals on Wheels. Maybe it goes to just people coming and helping out around the house for chore services. Then it comes to actually people coming out a couple hours to help. Then it comes to true skilled nursing. Then it can come to 24-hour care. So multiple things can make this a fact. And so my point to you is make sure you're properly protected. If you need help, that we can reach out. And for us, it's fantastic to get advice from us. Why? Because remember, we are not commission-based. So it's fantastic for a firm like ours because insurance is one of the few products that you have to pay the commission to, which is why we don't do insurance at Falcon Wealth Planning, because we're not allowed to receive commissions of any type. And what I don't like is for you to get advice from the person selling you the insurance that, oh, by the way, only gets paid when you buy. Don't you see that as the problem here? So we're able to help. We'd love to do it. Give us a call. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird. Folks, we're going to go on a quick break. We'll be right back after a few words. This is Gabriel Shahin, Certified Financial Planner, your host of More Knowledge, More Wealth. That's on every weekend. We're going over all important topics of personal finance. We're going over retirement planning, making sure you're prepared for retirement, Social Security and strategies, real estate, taxes, avoiding them now and in the future, investments, reducing fees, commissions, and so on, insurance, and estate planning. Folks, we are offering a free financial assessment that you could take advantage of. We have offices all across Southern California, including the Inland Empire. Give us a call to take advantage. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird, or visit our website, falconwealthplanning.com. That's falconwp.com for short. Enjoy the show. We look forward to serving you. Welcome back, folks. This is Gabriel Shahin, Certified Financial Planner, and your host of More Knowledge, More Wealth, here on every weekend talking about all important topics of personal finance. And today I wanted to go over with you just some updates, just what's going on. End of May, right around the corner here. We wanted to go over what has happened so far this year. And what I like to talk about is the lows of October of last year, where a lot of people were freaking out. And I was saying, just calm down. I could argue this is a fantastic time to buy. And people were completely worried. And I want to talk about since October 13th of 2022, just the lows of last October. The international stock market, that's the international, non-US, is up almost 32%. Okay, now that's actually towards the end of April. And then you have the US stock market that's up almost 18%. Heck, even bonds that people are freaking out about are up 6%. So get where I'm going with this? People freak out, folks. You want to be able to stay diversified and disciplined. This is more times than not why people hire advisors, not only because of the value they add, the advice that they give, the tax savings that they offer, the additional services that they provide, but also to keep your emotions in check. And we see more than times than not that people freak out. They get emotional. These are the mistakes you make in your personal life is due to emotion. Part of the reason why an attorney, why he doesn't represent himself in the courtroom. What they do is they get another attorney to represent them because of the emotional stake. Why a surgeon doesn't operate on their child. You get what I'm saying? It's too emotional. Now, I do like to also discuss potential Fed rate hike, okay? The Fed interest rate hike pause, okay? So the Fed said they're probably going to raise rates just one more time before the end of the year, okay? When you look at the average 12 months following the last interest rate hike, now that's coming up here, okay? So 12 months after, large value companies, historically speaking, since 1994, has done 27%. Overall stock market, 24%. Small caps, 24%. Large cap growth, about 20%. Value outperforms growth over long periods of time. It's really those low interest rate environments is where large cap growth does really well. In addition to that, you have to look at the international and emerging markets as well. It does 13 and 12%. So during these periods of times, it's crucial to make sure you stay diversified. And when you look at just the core of how the performance does, just as a whole, the U.S. over 12 months since 1994 does average 12%, just the U.S. in general. High yields actually do well as well. Non-traditional investments does fine. Municipals, 8%. Short terms, about 7.5%. Just in general, they do well. Now, when you also look at what's going on as money markets, the asset has reached the peak, a historic peak. There is so much money in there. Part of the reason is because, yet again, there used to be something called TINA. Now, what does TINA stand for? TINA stands for there is no other option. Part of the reason in 2000, 2001, a lot of money was going into the stock market. People talked about it was the stimulus. But in my opinion, the reality was there was no other place to put your money. So a lot of people were putting it in these Procters and Gambles and Johnson & Johnson and McDonald's and these investments that were paying dividends. And they were putting their monies in the Apples and the Googles and the Microsofts with growth-focused investments that were growing at 10, 20, 30, 40% a year. There was nothing else to do with your money. But now you can have a secure place to put your money market money in. And that's why we're having historical inflows and asset values in money market right now, because you're able to get that 4 to 4.5% rate. Risk-free. If you think about it now, everything has a risk associated with it. We talked about political risks earlier with potentially the defaulting of the United States treasuries with our government shutdown. So the idea with this is that the performance on this, historically speaking, is just not sustainable. The Feds have done a great job to build our interest rates to a level where if there is any tariff issues, any political issues, any recessions, anything that happens, a war, they're able to now lower rates to stimulate the economy, to help the economy, so we don't go into a deep recession. So the government has done a fantastic job increasing rates to where they are. You have to give credit where credit is due. Now, I also wanted to go over, when you just look at what is happening in the S&P 500 right now, when you look at the returns, okay, the average 2023 return, okay, of individual companies in the S&P index, okay, when you group rank them from the size of the firm, right? Because you got the largest 5 companies as what? Apple, Amazon, Microsoft, Google, Facebook, right? So, and they used to call them the FANG stock, where Netflix was in there. When you look at the top 5 companies, it represents over 22% of the overall market. When you look at 6 to 20, it's 17%. 21 through 100, it's just 5%. Then the 100 to 500 only represents 3% of the returns in the S&P 500. Why? Because the S&P 500 is market cap weighted. Unlike the Dow Jones. Dow Jones has 30 companies, and it's not market cap weighted, which means it's not the size. So if the Apple represented, which it doesn't, but if it represented 10% of these, because it's such a large company, let's just say it's a $3 trillion company, and let's just say American companies combined are 30 trillion. It's all larger than that. The Apple probably only represents 4 to 5% of the US. But the point is, if that's the case, that means it owns 10%. It's representing 10%. Now, That's how it is in the S&P 500. You would be invested in that specific example, 10% of just in Apple. Now, in this case, a majority of the returns that comes from the S&P 500 just come from the top 20 companies. Over half of the returns come from just the top 20 companies it holds. It's the same thing when it loses too, by the way, folks. What's the point? Stay diversified. Most people out there have these S&P 500 funds and think they're diversified. But really, you only have a majority of these top firms, and a lot of these firms are tech companies. By the way, folks, if you're just joining me, this is Gabriel Shahin, Certified Financial Planner, your host of More Knowledge, More Wealth here on every weekend, talking about all important topics of personal finance. We're talking today in general about your accounts, your stock market, your portfolio, making sure how markets work and understanding that what's going on in interest rates, what's going on inside the debt ceiling issue that's popping up, that always pops up, is making sure you're properly allocated, because a majority of the returns that come from the market is from these independent stocks. Okay. Now, I also want to discuss with you that when you take a look at your situation and you see how you're diversified, you're probably not as diversified as you think. Because as I just discussed earlier, the S&P 500 is market cap weighted. You're probably having a majority of your investments in tech only. And the majority of your investments are tech focused because those are some of the largest companies in the world right now. And that's how the S&P works. So please take advantage, especially when I just showed you and just discuss how value companies, historically speaking, which of course means no guarantee, but historically speaking, does very well and outperforms 12 months after the last Fed hike. And so we are looking at that ending soon. So where they'll stop raising rates. So folks, please be careful of that and stay diversified. And if you need help with that, folks, we can help. Give us a call. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird, or visit our website at falconwealthplanning.com. That's Falcon, WP.com for short. We'll be more than happy to put a personal, confidential conversation and assessment to relate this show to your situation. Answer the questions that you may have. Because what's going on right now, a lot of people are using the word unprecedented. And it's true. Everything's always unprecedented. I mean, we've had so much that's happened. We've had from 2016, from when Trump came in, the unprecedented time. You had that since 2018 as well, when the markets dropped. 2020 during COVID, 2022 with crazy inflation, 2023 with local regional banks going out of business. And now the debt ceiling that could finally affect you. Why? Because banks, people, so on and so forth, has invested so much money in treasuries now because they're earning over 5% guaranteed, risk-free for 3 months. And so it would seem like a no-brainer thing to do, where now it could actually be affected. It could affect your liquidity, so on and so forth. Be careful, folks. This is a time where you don't want to follow the next shiny thing that somebody's talking about. You have to be able to understand your situation, understand your liquidity, understand your needs, understand your goals, and still understand that the markets are still down. And when you look historically speaking, that leading up to the last Fed fund increase in interest rates, that the markets are unstable, and we are there now. And when we look at the 1 year after the last Fed rate increase, then the stock markets, historically speaking, do very well. I'm not here to predict that the stock markets are guaranteed to go up. All I know is that that's what the stock market does, regardless. People are fighters. People are performers. People are survivors. We are going to do whatever is necessary to live. And businesses are the same way because they're ran by humans. Their job is to make money. And as long as we believe that you and I are working because of a paycheck, whether we need it or because we want it or want more of it, it's because of that logic is why the stock market only goes up. Because businesses' goal is to grow. They wouldn't be in the stock market. Their intention wasn't to grow. So keep that in mind, folks. And if you need help determining a plan that makes sense for you, a plan that's liquid, a plan that's safe, a plan that can execute the returns that you're looking for, something that's not trying to sell you a false hope of zero risk, something that's not there for false hope, telling you you're going to get 20% returns guaranteed. That doesn't exist in the world. Don't be taken advantage of. And be careful as annuity salespeople are really ramping up their sales pitches. Be careful of what's out there, and we would love to help folks. Keep us in mind, we've got offices all over, headquartered here in Southern California. We would love to help. And if you have a question, we can play it on the air. Please send it to radio@falconwp.com. That's radio@falconwp.com. Folks, that was a fast show. I want to thank you for tuning in with us this weekend. You can always reach myself or any one of our colleagues here at Falcon Wealth Planning. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird, or visit our website at falconwealthplanning.com. That's falconwp.com for short. Folks, I want to thank you for tuning in. Have a fantastic weekend. Have a great week, and God bless.